All right, I need you to imagine something for me. You walk into your bank. You know, the one you've been using for 20 years. The one with the marble floors and the lady at the front desk who knows your name. You walk up to the teller and say, "Hi, I'd like to withdraw my money, please." And the teller smiles and says, "Sure, how much would you like?" And you say, "All of it." And her smile freezes. She types something into her computer. She frowns. She calls the manager. The manager comes over, asks you to step into his office, and very politely explains that while your account definitely shows you have $50,000, they don't actually have $50,000 in the vault right now. In fact, they don't have most people's money because banking doesn't work that way. They lent it out, invested it, used it, and they promise they'll get you your money eventually. But right now, this exact moment, they need you to maybe take $5,000 and come back later for the rest. How would you feel? Probably not great, right? You'd probably start wondering what else they've been lying about. You might even want to take that $5,000 and run. Now multiply that feeling by every customer the bank has. Everyone shows up at once. Everyone wants their money. The bank doesn't have it. That's called a bank run. And when bank runs happen, banks collapse. Congratulations. You just understood what happened to the COMEX in January 2026, except instead of people wanting their cash, they wanted their silver. And the COMEX, the largest silver exchange on planet Earth, the institution that's supposed to be the global benchmark for silver pricing, discovered it had a tiny little problem. They didn't have the silver. Well, they had some silver, just not nearly enough. And when everyone showed up asking for delivery at the same time, the vault started emptying faster than a keg at a college party. How fast? According to documented COMEX delivery data analyzed by Trading Key and published January 19th, 2026, between early and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX vaults in just 7 days. 7 days. That's 1 week. That's the time between Monday and the following Monday. That's less time than it takes Amazon to deliver a package. And here's the really fun part. COMEX's registered inventory, the silver available for immediate delivery, was approximately 127 million ounces at the start of January, according to warehouse reports. So 33.45 million ounces represents roughly 26% of the total registered stock. 1/4, gone in a week. Imagine Walmart announcing that 26% of their entire inventory nationwide just walked out the door in 7 days. Not sold, taken, removed, disappeared. You'd assume something catastrophic happened, a natural disaster, a zombie apocalypse, something. Except there was no disaster. There was just demand. Real, actual, physical demand from people and institutions who wanted silver bars in their hands, not contracts on a screen. And the COMEX couldn't say no because that's literally the whole point of a futures exchange. You buy a contract. You have the right to demand delivery. And if the exchange can't deliver, that's not your problem. That's their problem. And boy, is it a problem. But before we get into why this is the financial equivalent of watching a train derail in slow motion, let me give you some context. Because 33 million ounces might not sound like a lot if you don't know what normal looks like. Under typical market conditions, according to COMEX historical data, monthly silver deliveries run between 5 million to 15 million ounces. That's for an entire month, 30 days. And most months are on the lower end. The silver futures market is primarily used for hedging and speculation. Most contracts get closed out for cash or rolled into the next month. Actually, taking delivery is the exception, not the rule. According to multiple market analyses, less than 5% of silver futures contracts typically result in physical delivery. 5%. That means 95% of the people trading silver futures don't actually want the metal. They want exposure to price movement. They're not solar panel manufacturers needing silver for production. They're hedge funds and algorithmic trading systems making bets. This makes perfect sense because taking delivery is a hassle. You need to arrange storage, pay for insurance, handle logistics, deal with assay certificates. It's much easier to just trade contracts and settle in cash. But in January 2026, something changed. According to Pareto Investors' analysis, over 1,000 contracts went to actual delivery in a single day, with thousands more month to date by mid-January. That's not normal behavior. That's panic behavior. That's people saying, I don't care about hassle or cost. I don't trust this system anymore. Give me my silver now. And when you look at who is taking delivery, it gets even more interesting. According to the same Pareto analysis, JP Morgan and Citigroup were among the entities aggressively positioning to take maximum delivery. These aren't retail investors buying coins for their doomsday bunker. These are systemically important financial institutions, banks with trillions in assets. And they were pulling physical metal out of the COMEX like it was on fire. Now, why would JP Morgan want physical silver? That's a great question with a somewhat complicated answer. But the short version is this. If you're a major bank with access to all the delivery data, all the warehouse reports, all the flows that retail investors never see, and you start demanding delivery, you probably know something. Maybe you know the inventory is lower than public reports suggest. Maybe you know demand is about to spike and supply is tight. Maybe you know other big players are also taking delivery and you want to get yours before the vault runs dry. Or maybe, just maybe, you remember what happened the last time a major commodity exchange ran out of deliverable supply. And you don't want to be holding paper when the music stops. Because here's the thing about JP Morgan and silver. According to CFTC records, JP Morgan paid a record $920 million fine in September 2020 for manipulating silver and gold markets through spoofing from 2008 to 2016. That's not ancient history. That's 5 years ago. 2 of their traders went to federal prison. Michael Nowak got 1 year. Greg Smith got 2 years. This actually happened. So when the bank that was convicted of manipulating silver prices suddenly decides they want maximum physical delivery, that's not random. That's a signal. And the market is paying attention. Now let's talk about what 33 million ounces actually represents in terms of global supply, because context matters. According to the Silver Institute's data, global annual silver production from mining is approximately 830 million ounces. So 33 million ounces is roughly 4% of annual global mine production. Doesn't sound like much when you put it that way, right? Except it's not about the percentage of annual production. It's about the percentage of available inventory at exchanges. And that's a very different number. The COMEX registered inventory is silver that's sitting in approved warehouses, available for immediate delivery to settle futures contracts. According to warehouse reports compiled by multiple sources, including Trading Key and Chronicle Journal, the COMEX registered stock entering January 2026 was approximately 127 million ounces, though some reports cite the number closer to 45 million, depending on how you categorize eligible versus registered. Let's use the higher number to be conservative. 127 million ounces. If 33.45 million got withdrawn in 1 week, that leaves roughly 94 million ounces. But here's where it gets spicy. That withdrawal rate was accelerating, not slowing. According to the same data, thousands more contracts were demanding delivery throughout January. So let's do some very simple math. If withdrawals continued at the rate of 33 million ounces per week, the entire registered stock would be gone in about 3 weeks. 3 weeks. That's not a sustainable system. That's a countdown to zero. Now, obviously, the withdrawal rate probably slowed as prices spiked and the CME intervened with margin hikes. But even if the rate dropped to half, you're looking at 6 weeks to empty the vault. That's still catastrophic for an exchange that's supposed to be the global pricing benchmark. And before you say, well, they'll just bring in more silver from other warehouses, let me stop you right there. According to Chronicle Journal's analysis published January 2nd, registered silver inventories in Western vaults have plummeted by over 70% since 2020. 70%. That's not just COMEX. That's across the London Bullion Market Association, COMEX, and other major depositories. The cupboard isn't just running low, it's nearly empty. Where did all the silver go? Great question. According to multiple analyses, including Financial Content and Bullion Star, it went into 3 places: industrial consumption, ETF and private investment, and direct delivery to large buyers who don't trust paper anymore. Let's start with industrial consumption, because this is the monster nobody wants to talk about. According to the Silver Institute's World Silver Survey data cited across multiple market reports, 22-25 marked the 5th consecutive year where global demand exceeded supply. Not by a little bit, by 140 to 200 million ounces annually. Do that math over 5 years. 140 million ounces per year times 5 years equals 700 million ounces of cumulative deficit. That silver got consumed, used, turned into solar panels and electronics and EV components. It's gone. You can't just call it back. Industrial silver doesn't get recycled effectively because it's dispersed in small amounts across millions of products. When you throw away your phone, that 0.3 grams of silver in it is economically unrecoverable. So the above-ground stockpiles that used to buffer the market, the silver sitting in exchange vaults and bank storage, have been getting drawn down year after year to fill the gap between what mines produce and what industry consumes. And then in January 2026, the industrial users and large investors simultaneously realized, oh wait, those stockpiles are almost gone, and rushed to secure supply before it disappeared completely. That's what triggered the delivery surge. According to Financial Content's January 20th analysis, by late December 2025, the COMEX faced delivery demand of nearly 65 million ounces. The exchange reportedly struggled to fulfill this demand, leading to widespread market rumors of cash-only settlements. Cash settlements mean the exchange pays you money instead of giving you metal. That's fine if you wanted money, but if you wanted silver for industrial use, cash doesn't help. You can't make solar panels out of dollar bills. And this is where the system starts to crack. because the futures market is built on the assumption that it's connected to physical reality. The futures price is supposed to reflect the price of actual silver. But if the exchange can't deliver actual silver, then what is the futures price really measuring? It's measuring the price of a promise. And promises are worth exactly as much as the entity making them is trusted to keep them. When rumors start circulating that COMEX might not be able to deliver, trust evaporates. And when trust evaporates, everyone rushes for the exits at once, which is exactly what we're watching. Now, the COMEX's response to this crisis was both predictable and pathetic. According to Seeking Alpha and Financial Content, the CME Group issued Advisory 25-393 in late December 2025, raising margin requirements for silver futures to $25,000 per contract. That's a massive increase designed to force speculative traders out of the market. The logic is simple. If holding a silver futures position becomes prohibitively expensive, people will close their positions. Fewer open positions means less delivery demand. Less delivery demand means the exchange doesn't run out of metal. Problem solved, right? Except it's not solved, it's postponed. According to Seeking Alpha's analysis published January 1st, the margin hike caused a temporary price crash, with silver dropping nearly 15% in 1 week to below 72. The article describes this as a textbook paper smash, designed to save deeply short bullion banks from the impending physical shortage. And that worked for about 2 weeks. Silver crashed from $84 to $72. Weak-handed speculators got flushed out. Leveraged traders got margin called and liquidated. The COMEX got a brief reprieve, and then the price came roaring back. Within 3 weeks, silver was above $90, then $90. Because the margin hike didn't fix the underlying problem, it just temporarily obscured it. The problem is that there's a structural supply deficit. The problem is that industrial demand is consuming more silver than mines produce. The problem is that China banned exports. The problem is that above-ground stockpiles are depleted. The problem is that the paper market promised 356 ounces for every 1 ounce that exists. You can't fix those problems with margin requirements. You can't manufacture silver out of financial engineering. And you can't make people trust a system that just demonstrated it does not have the metal to back its contracts. So what happens next? Well, we're watching it play out in real time. And there are basically 3 paths forward, none of them particularly pretty. Path 1, the controlled bleed. The COMEX continues to experience elevated delivery demands, but manages to avoid outright default by using every trick in the book. Cash settlements, delivery delays, rolling positions forward, encouraging large holders to keep their silver in COMEX vaults even after taking delivery so it technically stays available, regulatory intervention to limit position sizes, emergency rule changes. Basically, the exchange does everything possible to slow the bleeding without admitting they have a problem. Silver prices continue to rise because the physical shortage is real, but the COMEX survives as an institution, albeit a deeply wounded one. Physical premiums remain elevated. Trust in paper markets erodes further, but the system muddles through. This is the kick the can down the road scenario. It's what authorities usually do: delay the crisis, hope something changes. Maybe mine production ramps up. Maybe industrial demand softens. Maybe China reopens exports. Maybe prices rise enough that some hoarders sell. There are lots of maybes, and kicking the can gives those maybes time to possibly materialize. Path 2, the exchange default. Delivery demands continue to accelerate. The COMEX runs out of registered inventory entirely. A major commercial buyer demands a delivery. The exchange cannot fulfill it. Force majeure gets declared. This is the nightmare scenario the exchange is desperately trying to avoid. According to multiple analyses, including Financial Content and Chronicle Journal, if this happens, silver prices would likely spike violently. We're talking $150 to $200 in days, maybe hours, because a COMEX default would shatter any remaining trust in paper markets. Every holder of silver futures would simultaneously try to either take delivery or close positions. The exchanges would halt trading. Regulators would intervene. Positions would get forcibly cash settled. It would be chaos. And then, after the chaos, there would be a restructuring. New rules separating paper and physical markets explicitly, probably government strategic reserves, possibly restrictions on speculation. The silver market would look completely different on the other side. Path 3, the voluntary retreat from paper. This is the interesting one. What if large players simply stop using COMEX for price discovery? What if solar panel manufacturers and EV companies and defense contractors just sign long-term direct contracts with mining companies, bypassing exchanges entirely? This is already happening according to multiple reports. Financial Content notes that we are likely to see more direct-from-mine offtake agreements as solar panel manufacturers and tech hardware companies seek to guarantee supply without being subject to the volatility of the COMEX. If this trend accelerates, the COMEX becomes increasingly irrelevant. It remains as a speculative venue for traders, but actual physical users ignore it. The paper price and the physical price permanently diverge. You end up with two separate markets, a paper market for gambling and a physical market for actual commerce. This might sound weird, but it's not unprecedented. Look at oil. There are paper oil futures, and there's the price of actual oil cargoes negotiated between producers and refiners. They're related, but not identical. The same thing could happen with silver. And honestly, given what we're seeing with the 80% premium between COMEX and Tokyo, we might already be there. The market might have already bifurcated, and we're just watching the COMEX slowly realize it's become a sideshow. Now let's zoom out and talk about what this means for anyone who is not a commodities trader or industrial buyer. Because I know what you're thinking. Okay, the COMEX is having problems. Why should I care? Fair question. Here's why you should care. The COMEX isn't just some random exchange. It's the price-setting mechanism for silver globally. When someone quotes you a silver price, they're usually referencing COMEX futures. When ETFs buy silver, they often use COMEX pricing as the benchmark. When mining companies hedge their production, they use COMEX futures. The entire global silver market is built on the assumption that COMEX prices are real, accurate, and connected to physical supply and demand. If that assumption breaks, if COMEX becomes disconnected from physical reality, then we don't have a reliable price for silver anymore. And if we don't have a reliable price, we have chaos. Because pricing is how markets allocate resources. It's how we determine who gets the limited supply. It's how we incentivize more production. When pricing breaks, everything downstream breaks. Industrial users can't forecast costs. Miners don't know whether to expand production. Investors can't value assets. Banks can't make loans. The entire system depends on price signals working. And right now, the price signal is flashing red and making a horrible grinding noise like a transmission about to fail. Here's another way to think about it. According to Bullion Star's analysis, they've experienced record-breaking demand and noted that replenishing silver has become increasingly challenging. Rising acquisition premiums and longer delivery lead times from suppliers have made it necessary to adjust pricing. That's corporate speak for we can't get enough silver, and when we do find it, it costs way more than it used to. Bullion Star is one of the largest physical dealers in Asia. If they're struggling to get inventory, that tells you the shortage is real and pervasive. And it's not just Bullion Star. According to their report, many competitors are either completely sold out or operating with severely limited stock. This isn't one dealer having a bad month. This is systemic shortage across the physical market. Now combine that physical shortage with COMEX losing 26% of its registered inventory in 1 week, and you start to understand why people are panicking. Because if you're someone who actually needs silver, a manufacturer, a tech company, a defense contractor, you're looking at a market where exchange inventories are collapsing, China banned exports. 5 consecutive years of deficits have depleted stockpiles, dealers are sold out or running on fumes, prices have tripled in 12 months, there's no relief in sight. What do you do in that scenario? You secure supply now at any price, because if you wait, there might not be any supply at any price. And if you can't get silver, you can't manufacture your products. And if you can't manufacture products, you don't have a business. That's what's driving the panic. It's not irrational speculation. It's rational actors responding to genuine scarcity. And this brings us to the broader question. How did we get here? How did the global silver market end up in a situation where the primary exchange is hemorrhaging inventory and can't keep up with delivery demands? The answer is a combination of factors that converged over years, then accelerated dramatically in 2025, 2026. Factor 1, chronic underinvestment in mining. According to Financial Contents Analysis, new mine development takes 7 to 10 years from discovery to production. The price signals from 2020-2025 weren't strong enough to incentivize major new supply investments. And even now, with prices at $95, the metal won't hit the market until 2032 at the earliest. We have a decade-long lag between price signals and supply response. That's a structural problem with no quick fix. Factor 2, silver is mostly a byproduct. About 70% of silver production comes from copper, lead, zinc, and gold mining. You can't just mine more silver. You need to develop base metal deposits that happen to contain silver. This makes supply extremely inelastic. Even with high silver prices, if copper demand is soft, copper mines don't expand, which means less silver byproduct. Factor 3, the green energy transition. Solar panels, EVs, and electronics all need silver. These aren't speculative demands. They're mandated by policy. Governments have committed to electrification and renewable energy. That demand is locked in. And it's growing exponentially while supply crawls at 2% per year. Factor 4, years of price suppression. Now, this is where it gets controversial. But according to documented legal cases, JP Morgan and other banks manipulated silver prices downward from 2008 to 2016 through spoofing. They paid fines. People went to jail. This happened. The effect of that manipulation was to artificially suppress prices precisely during the years when supply investments should have been made. By the time prices recovered, we had lost a decade of potential mine development. We're now paying the price for that lost decade. Factor 5, the paper to physical ratio. For years, the ratio of paper silver trading to physical silver in existence ran as high as 356 to 1, according to Trading Key. This created an illusion of liquidity. It made the market appear much larger than it physically was. And as long as most contracts settled in cash, it worked fine. But the moment people started demanding actual delivery, the mirage collapsed. Turns out, you can't deliver 356 ounces when you only have 1 ounce in the vault. And Factor 6, China's export ban. On January 1st, 2026, China restricted silver exports, effectively removing 60 to 70% of refined silver from global trade, according to Pareto Investor. This was the spark that lit the fuse. It didn't create the underlying shortage that already existed, but it made a bad situation catastrophic by cutting off the supply valve the West had been using to paper over deficits. All 6 factors working together created the perfect storm, and COMEX got caught in the middle. So here's where we are. In 7 days, in January 2026, 33.45 million ounces of silver, 26% of registered COMEX inventory, got physically withdrawn. The exchange is bleeding silver. Delivery demands remain elevated. Physical premiums are running 40% to 80% above paper prices, depending on location. Industrial users are panicking. Dealers are sold out. And the pricing mechanism the entire world relies on is fracturing in real time. What happens next? Honestly, nobody knows. But I can tell you what doesn't happen. We don't go back to normal. Normal was the COMEX having ample inventory and smooth deliveries. Normal was paper and physical prices being aligned. Normal was silver trading at $20 to $25. That normal is gone. The new normal, whatever it looks like, involves higher prices, physical premiums, supply constraints, and a lot less trust in paper markets. The only questions are how high prices go, how long shortages last, and whether COMEX survives as a relevant institution. According to Bank of America's analysis cited by B in Crypto, silver could reach $135 to $300 in 2026. That's not some fringe prediction. That's a major investment bank looking at the same delivery data, the same inventory levels, the same supply-demand fundamentals, and concluding that we're nowhere near the top. Because here's the thing about supply shortages. They don't resolve quickly. You can't snap your fingers and create more silver mines. You can't magically increase recycling rates. You can't substitute another material in most applications. The shortage is real. The deficit is structural. And the resolution will take years, not months. In the meantime, we get volatility. We get price spikes, we get dislocations between paper and physical, we get exchanges struggling to fulfill deliveries, we get industrial users bypassing exchanges entirely, we get a market in transition from one equilibrium to another, and that transition, it's messy, it's chaotic. It's exactly what we're watching right now. So the next time someone tells you commodities markets are boring, show them this. Show them the week COMEX lost 26% of its inventory. Show them the $130 premiums in Tokyo. Show them the 5th consecutive year of deficits. Show them JP Morgan demanding maximum delivery. And then tell them that's not boring. That's a market breaking. In real time, the bank run started. The vault is emptying. And nobody knows if there's enough silver left to satisfy everyone who wants their money back. Welcome to the silver squeeze of 2026, where 33 million ounces disappeared in a week, where the exchange is bleeding inventory, where paper and physical have diverged, and where the biggest question isn't whether the system breaks, it's when.